Greg Poole and Pat Dwyer from NewEdge, and we wanted to take a moment just to give folks an update of where things stand year to date and get a sense of how things are performing. We have here a number of different asset classes, and it's important to remember these aren't precise. The equities are pretty much through mid-year, and the privates are through May, and all of these would be before 50 basis point maximum management fee is charged by us. But this still gives a pretty good sense of how things are shaping up year to date. I'll start talking a little bit about the equities. It's been a volatile year so far, but actually all in all, a pretty good one. If we think about our side bets, Blackstone has had a tougher year after having two huge up years. We always say we love the business, but it's a very volatile stock. It's pulled back a little bit this year as rates have gone up, and it had a really big move. But we're quite optimistic that the markets are going to open up, the capital markets are going to open up, and they're raising a lot of funds with their new evergreen funds. So that's down about 12%, and that's offset by Welltower, which has had a really good run, really since we bought it, as that's continued to perform and viewed as a defensive yield play, and is up over 20%. So the side bets altogether are up around 6% gross. And then if we look at our direct index, the US has come back really strongly. It had initially been a tale of two cities where we have international stocks and US stocks. International has been really strong, and those have continued to do well, but have paused, while the US markets, which were down during the initial tariff rout, have really bounced back. So overall, our OSAM tax efficient index is up over 9% year to date and has generated a lot of tax losses for our clients because of the volatility. And then our third side bet, which we integrate into the VISE Global Index, which is the semis index, is also having a strong year. It's now in its third strong year. And again, remember, it's something we're really bullish on, first from AI and then ultimately for robotics. So overall, the equities have done quite well this year.
Yeah, they really have. And it's very exciting to see the non-US equities get in the game. The last part of our equity allocation that really hasn't done much in a long time is we have small mid-cap exposure in the direct index. And that's just recently started to percolate a little bit. That's starting to work so that's a great mix of cheap and expensive. And we're very bullish that our AI thesis that AI is going to make the average company more profitable is really playing out. In fact, there's articles in the newspaper today from public companies saying this is really happening. So we think it's a great time to just be very long equities and stay there. Let's look at fixed income for a second. Tax-free fixed income. And, we're not a huge fan of fixed income. Fixed income is a placeholder. It's a place to hold capital that you don't want to lose. Tax-free bonds, the Belhaven Municipal Bond Ladder is up 2%. Remember, that's a tax-free fund. PIMCO High Yield Municipal Fund is up minus 0.82, and First Eagle High Yield Municipal is minus 1.47. The high yield municipals, which are paying over 5%, got a little banged up in the last quarter. You can see that last year, both of them had great years, 4.5 and 11.95. If we get into our core taxable fixed income, the Dolan McHenry Ladder is up 4.5%, which is very good. The Guggenheim Total Return Fund, 462. PIMCO Income Fund, 5.58. Principal Preferred Capital Fund, 3.65. Great year last year at 9%. And again, all these, we would assume there's a 0.5% fee on top of this as well, which would take probably about 0.25% off this return year to date, approximately, but you may be paying less than that.
The taxable has done its job. The munis have obviously been the laggard. And I'd say if there is an area we find some value in fixed income, it is the munis right now. Just jumping into private credit, I'd say it's done fine this year. People have been quite worried about all the capital that flowed into private credit, but we're still seeing deals getting done at an attractive rate. So the private credit funds we have, Blue Owl is up about 3%, BCRED is up 3.6%, and the Apollo Diversified Credit is up about 4.5%. So that basket kind of equal weighted is up about 4%. And again, that's through May.
Right. And then through May on the real estate side, which we view these as cash flowing vehicles, Blackstone Real Estate Income Trust, a return of 262, and Fortress Net Lease, 421. Remember that most of the cash flow from these investments is return of principal, so you're not paying tax on it. Real estate looks like it's beginning to recover. So real estate's been a tough space. If you look at the historical returns, they were amazing. And then 2023, 2024 were much tougher years, and it feels like we're kind of coming out of that at this point in time.
I'd say on the infrastructure side, these are funds that we've started talking about a lot more. We really like this, asset class. And we'd say that they're performing strongly. And Blackstone's BX Infra is up nearly 4%, and Ares Core Infrastructure also up about the same. And again, we talked about the tax preferability, the Blackstone Infrastructure Fund. About 70% of that is tax free effectively, and Ares is even higher. So, these are both, we think, important parts of a diversified portfolio that we like a lot.
Yeah, it's we just cut a video, which you'll get to see shortly, on infrastructure with the CEO of Blackstone Infra. Last but not least, Blackstone PE, which is their new flagship private equity fund, and it's a combination of secondaries, their growth equity, their traditional buyout fund, and a little bit of exposure to their biotech. And that's up 8.5% before our fee through the month of May. So very strong performance there. You can see why these evergreen structures are going to be very attractive to investors. You have lower fees, you're fully invested day one, which we think is huge in terms of compounding. And you have some access to liquidity. They can always gate you, keep in mind, but if our guess is 2 years out of 10, they'll be gated, and 8 years out of 10, they won't be. So it's a lot more liquidity than a draw fund and lower fees. So that's where we're at mid-year. We remain really optimistic on the next decade. We think this AI revolution is really coming, and we don't have our venture funds and all those kinds of things up here because not everybody owns those and they don't report monthly. But we think it's a great time to be invested. We think it's really important to be fully invested because we're in a time of moderate inflation. Equities and these other things will protect you from that if we do have inflation. Greg, anything else?
And I was going to say, one of the things we just wanted to show is, despite all the angst and consternation that folks express, really pretty much all the asset classes have done pretty well this year. It's been one of those markets where, by and large, the portfolio has seen contributions from almost every area.
Yeah, I just want to say one last thing is that, Wall Street is always about selling you and getting you excited about whatever. We say the same thing all the time. If you do nothing else but own our direct index, that's probably the most important part of your asset allocation the next 10 years, because there's going to be a high failure rate. AI is going to disrupt a lot of businesses, and there's going to be a lot of new winners. And an index is the perfect way to approach it, because the losers drop down and you tax loss them out, and the winners go up. We don't know who the winners are. Only 7% of managers outperform a benchmark over time, 0% do after tax. And our strategy is really working. We're broadly invested enough that I think that we're going to get through whatever the market throws at us. Thank you for your patience. Thank you for staying along. We appreciate your support. Call us if you have any questions. Thank you so much.